Morning, everybody. Time to get back at it on the trend following world. Our weekly meeting. I love the Fridays, man. Nothing better than Friday, honestly. Saturday. Yeah, Saturday's a bit better. Stick figure in town in Tampa. Sunday. What a day. What a day that's going to be. I'm delaying my vacation at least a day or two because they're here. I have to go. My wife is very skeptical of this concert, but hey, I said you don't have to go, right? But it's going to be fun. It's been a good week. We got the ETF. It was approved, and I think we can start trading on July 6th. The holiday's messing us up a bit into the month, but yeah, we're all pretty excited. 150 stocks, 300 markets. Yeah, you're going to look inside the portfolio, see all these fun stocks I've been talking about. Very, very humorous. You'll enjoy that. I only have an hour today, so we'll get right at it. And a lot of fun things to talk about with podcasts and tweets and the articles, analog, digital, floor and court. Oh my, 500 markets, 2,000 stocks. I'm so wimpy. 300. Very sad. My little 300. So sad. Oleg, how goes it, my friend?
Hi, Jerry. Hi, Richard. Hi, Brian. Hi, Bruno. Hi, Seth, and all the guys. Of course, all the guys I see here, and of course, I'm very happy to see here and to see you all here every time. And I hope that my technology will be better in the beginning of every conversation. I'm, as a trend follower, hope for the best. That my technology will be better than recent 4 or 5 months, and so had a nice week because I'm a trend follower, and I mentioned that I like when I listen some business courses, business books, and I understand that these authors, they apply our trend following principles to business. For example, I have listened Alex Hermos's books. He is a businessman, not a trader, and he said that we must have a big winners, and these big winners will pay for our losers. And when I listen, read, or hear when I read or listen such things, I feel happy because I understand that we can apply our principles almost to everything. So these guys are not talking about prediction models, about carry models, or something about short-term models. They talk about about models that are similar to our models. So our trend following principles are really universal. And I have said it many times, and I'm going to say it again and again for decades, because I'm sure. So, and it's the best evidence for me that we have the best strategy, because our strategy can be applied to almost all fields of life, and even in nature we see how our strategy, how our trend following principles work. So I'm sure it will be happy discussion today, and I hope that my technology, as I have said before, will be better today. I use another phone. I use iPhone today. Maybe it will be better. I hope so. So let's get started.
Very good. Let's get started. Yeah, so we can start with this tweet I wanted to talk about that my friend Mark put out. Well, it's an article, and I tweeted it. And I think what he's saying, the benefits of more of a fluid type of a systematic approach where you're always kind of in the markets, and as the probabilities of success increase for the longs, you're adding to those markets. And then as the probabilities decrease for that long, you're kind of gradually decreasing, then maybe even going short. and I think he calls that analog. And so I guess one entry, one exit, and a stop loss is kind of digital, binary. And he was just talking about how there are more benefits, I guess, to this continuous type system that's always long and short. And of course, I don't think we want to predict, and I don't think I look at it as the probabilities of the market going up and up and up, or the probabilities of it going down and how that changes. I look at it more like the probability that I should get out of this trade with system one, it has increased to the level that I need to get out. So, and I think if you try, my point was if you have trade a multiple system approach, one entry, one exit, and a stop loss, it is somewhat probabilistic, and it doesn't suffer from this over optimization of loading up like one system or putting all of your ideas, or not separating the systems and putting it into one system that kind of scales up, scales down, with, if this happens, then we'll do that. We'll get out here or we'll get out there. These or type systems, which just devastate sample size of the trade. Well, they don't go with sample size anyways. Most of them don't even pretend sample size must be the days in the markets or each day's return or the kind of number of trades you do, irrespective of what generates those trades. So I think you can still have this kind of, we talk about this all the time, and he doesn't really mention this for some reason, comparing a continuous type system to multiple one entry, one exit, classic trend following type systems that give you somewhat of a diversification and weighting of your systems. I wouldn't say that we start from the premise that as the market gets better, as the odds get better, we are adding. We're more like diversifying with different systems. And when the expectation of system one gets closer to zero, we get out. And we may still be in two and three, or two and three may not have been engaged. So that could be good as well. So I wasn't really sure where he was going with all of this. What do you think, Richard?
G'day, Jerry. G'day, everyone. Look, before I start, Jerry, congratulations on your ETF. It's a great achievement. Looking forward to hearing a bit more from you about the trials and tribulations of getting this all up and running, and how it's going, and which podcast you're going to be on shortly to talk about the ETF. I know you've done Covel, etc. But anyway, on the digital versus analog signal that Mark Rezebczynski was talking about, yeah, look, that comes back to the age-old argument that or debate that we have on here about using complex overlays, adjusting positions in a sort of an analog way or a continuous way as opposed to a discrete way. Look, I think we could be arguing this until we get all blue in the face about it, but when you look at complex systems, binary does not mean it's not complex. I mean, when you come down to quantum mechanics, you know that it's ultimately binary decisions from a wave function. So we know that binary does mean complexity. So for those to say that, their analog processes are much more sort of elaborate and complex and, current day thinking, Bayesian in approach, I think is a bit of a furphy. I think it's just describing a different approach where they are varying their models in a continuous way as opposed to a discrete way. I think that there are problems associated with that method, as there are problems associated with binary. But if people could demonstrate to me that one was significantly more successful than another, I might listen. But otherwise, it's just, to me, a sort of a redundant argument that's really the same old argument we get into when we talk about volatility targeting and all of those sort of arguments.
And I think that first of all, we must have a universal mathematical approach, and it must be, of course, we all know that it must be as simple as possible, and if so, it will be less fragile. It's our strength. And as I have said before, this volatility targeting and something like this, I don't even understand why do this. Really, I don't even understand why do this. And maybe in some periods it shows better, but it means nothing for me. Our approach, it's universal, and I know it's universal and simple, and I'm sure that it will keep working. And I'm not so sure in this volatility targeting things and some complex approach. I'm not sure that it will be working tomorrow, for example. And history means nothing for me here, because for me, first of all, I need logic plus history, logic behind the system, philosophy, plus as much data as possible. For me, first of all, this is my approach.
Hi guys. Hey Jerry. I mean, the the thing that is very difficult in this age is, when when managed futures would say something else like we are doing real time risk management. Okay, do you know how sexy it sounds? How condescending it sounds if you're not doing real time risk management? So it is very catchy, and it is very easy to to explain everyone else that it puts you into an high ground. And anyone else who's not doing real time risk management must be inferior, right? Because we are first and foremost risk managers, and if someone else comes and says to you that I am doing real time risk management, I'm looking into the correlations not on a historical basis, but also on a real-time basis. Wow, how are you doing that? It looks superior. It looks, super cool. So I think these are the areas where the the savvy investor that who really understand the process and these complex systems are a little different than the ones that who are looking for maximum 10% drawdown in a multi-strat. And a lot of people are much more attuned to be able to there are lots of unsophisticated investors out there, and I understand from their perspective that maximum 10% drawdown is very appealing. So so that's why we need to keep the message very clear, and we need to emphasize the importance of not doing the real-time risk management, because we would like to keep our CAGR at a higher level, and we don't want to be cutting our winners short, which is the first. Well, I mean, we have many sins in this business, and one of them is cutting winners short, and not diversifying enough, not taking small bets. And even though the managed futures are doing possibly many of those, they are definitely have a different philosophy when it comes to real-time risk management. Thanks.
Hey, hi everyone. Glad to be here. Congrats, Jerry, on the new ETF. I'm glad I'm eager to see it running. On this analog versus digital, I tend to agree with Richard. I think that usually we use continuous functions and model things on a continuous way, mostly to simplify things, to make the math more tractable, to ease our analysis, and I mean to make the analysis easier, but then we come down to the point that why do you need to simplify this? Why do you need to make this assumption of continuous stuff to make it analog, in Mark's words, when we have this discrete system that serves us all well? I really can't see why is it superior. I think it's just a different approach. I don't think it's evidently better, as some might say. And this thing of that Alp just mentioned of continuous risk management, I would say that it's it's a narrative, and that's all. And we can say that we do continuous risk management as well. We can say that we increase our exposure in $1 for every dollar that we earn for each trade. How about that?
Yeah, I think another point I wanted to make was that all of these ideas, they just have pros and cons. And when things happen in the markets, it may be something small and a lot of small little negatives. And then you see a big positive when I do something or a different strategy does something. And so or the brain doesn't always pick up all the little nicks and cuts that you get. I remember Rich telling us, like, yeah, don't do market orders because you will lose every time just a little bit and you won't even think about it. And then you add it up and you're like, oh, well, that's way worse than using limit orders. But if you use a limit order, you're going to have a story to tell about chasing a market all day long. You never got it. You had a tremendous amount of slippage in 1990 something, and boy, that's just to be avoided. But when you throw that unfortunate thing in there, and you add up all the times that you didn't get nicked from a market order, it'll come out positive on your side. Um, and I'm always shocked of my performance because I'm sitting in there with these long-term systems that don't do very many trades, and I give back a lot of profit on a profitable trade, but I'm not getting nicked. I'm not constantly doing trades and getting it wrong. And so that kind of adds up. I've just been short interest rates the whole time. Chinese renminbi. I just never got out. It crashed and then it went right back up. And so this stuff happens. Feeder cattle never got out. Never. No. I was giving it all back if it needed to. Boom. A week of horrendous prices followed by a week of right back to the highs. And Neil sort of talked about this in one of his recent podcasts. I think I mentioned it last week. He was just going through what happened on these short interest rate trades back in March. And he's like, well, the beginning of March, volatility went down, so vol managers added to the position. And then SVB came along and they all got out of them because vol went up. And then after that passed, they went down again, and you had to sell them again. And so you tend to focus on the profit give back and not this choppiness and this period of where you're getting beat up with little irritating trades where you're just zigging and zagging at the wrong time. But the computer doesn't forget. It does not. It counts those. And your brain just looks at that big profit give back. I made less than everyone else on this big trend, or I had the biggest drawdown on this big trend. And why don't I do something about it? Do something about it. And the computer says, yeah, if you isolate periods or trades, you're right. But if you look at all of them, this is what you're going to get. You thought I was going to say, what Jerry does is better. No, I'm not going to say that. I'm saying this is what you're going to get. So live with this total result and try to not let your human biases get rid of uncomfortable situations that, by following those rules, if you look at all of the trades, you would choose to do it this particular way. Everything has its pros and cons, and the computer is very good at totaling them all up to tell you net what is the best idea, and we're very poor at that.
It's very interesting topic because often people don't, most of the investors mostly don't like this getting back in our profits, but it's one of the it makes our trading very safe. It makes our trading very safe, very strong, and I think maybe we must educate our investors in this, and trend following as an approach will be more popular, I think, if people understand that this giving back profit, it's a part of a winning strategy. It's a strength, it's not a weakness. And really, one of the most interesting topics in trend following, I think, is but and so we have a lot of diversification. So the process is more smoother, of course, because of diversification. But it's really very interesting.
Hi guys, can I say something about the analog thing? I think that one issue that goes for it is that if you do that kind of thing, you're kind of averaging, and then if you're averaging, you're lessen the risk of having a particularly different and bad short-term performance against your peers. Uh, maybe that's something that makes it something to go for it, because for example, I remember when I was looking at some funds and compare them in some years. I remember, for example, Mulvaney in a certain year losing money when all the other trend followers earned money, and maybe it has to do with this discrete versus analog thing. You know, when you're discrete, you're having more path dependency, or that could be the case. And, you know, if that happens, then you will have to justify short term discrepancies that are hard to justify. You know, for example, having a whole, between commas, a whole year when you lost money and everybody else won. So, going to this kind of analog or continuous thing that I don't personally want could be useful for that, for not being in a bad situation where you have to explain what everybody else doesn't have to.
I think every strategy has its periods of underperformance, and we must understand all the situation, all the logic, all the data to do some conclusions, suggestions about this. We must do a lot of backtests. For me, personally, I had done tons of backtests for many years in different directions, and classical trend following approach is the best approach I have ever seen.
I understand that, but you know, as I said, in some years you could see that trend followers made a positive return, and one trend follower who maybe I think it is more discrete than analog, did a negative return. And you do that, and you have to do a lot of explanation just because of the sign of your results. So, you know, when you do those kind of averaging or going non-binary, in this sense, non-binary meaning going up and down or adding to your positions or removing, maybe you're averaging, and in your averaging, you won't have that problem, the problem of having to justify why you are the only one who had that result. Of course, always when it's negative, never when it's positive.
You know, when you're trading long term, so there is a big industry, the long term trend following industry, and more or less long term traders enter on the same week, give or take. But the short term industry, the results, the dispersion is very wide. Okay, so and you do not have this much of a cohesion that the long term industry has. Short term manager results are much more widespread. Now, I'm saying this when Cordura says that you have to make an explanation of your results. Yeah, I mean, you're not trying to be correlated to the others. If you have a strategy that is acting less correlated to the rest of the industry, I see it as a strength. And again, we are coming back to your personality and your beliefs about how life works. I would rather explain myself all the time than do the same thing again and again. I would rather be the black swan myself rather than a slightly different replica of what the others doing. So, as a personality, I would never ever wanted to be on a similar bucket. I would rather be doing something else, and there will be ups and downs, but it is how I, how I'm designing the trading strategy. So that's how I think, actually. Thanks.
Debate regarding continuous and discrete. Really, you've got to be careful what you're debating here, because you've got to look at your process. And there are certain aspects of our process where we do apply a continuous basis for adjustment. And that's in the normalization process we apply with our ATR, where we normalize every single market we trade. And the rationale for that is that we want to trade each market exactly the same way with our effectively discrete models. That normalization process is a continuous process. It's not a discrete process. But then when we have applied that process, the rules we apply for the execution of that trade on entry and exit is effectively a discrete process. So we're applying we're not tampering with our trade during the course of trade management from entry to exit. And the reason we do that is we are looking at risk from a trade by trade basis as opposed to a portfolio risk basis. In other words, we're saying we can obtain, in these tails of the distribution, we can obtain better control of our risk by looking at our return streams at an individual basis as opposed to a collective basis where we are reshuffling weights in the portfolio using continuous processes. We're saying, no, we prefer in the tails where we have very little information to work off. The best thing to do is apply these physical mechanisms of stop and trailing stop, or stop and one stop and one exit, as a means to control our risk. Now, others who are not targeting the tails would have a lot of justification for why they'd apply a continuous process between entry to exit, because they're not necessarily harvesting trends from the tails. They're harvesting different forms of trends like mean reversion elements and those sort of trends that are found in the bulk of the distribution. So, these debates, we tend to go round and round in circles, because what we're saying is that, look, there's no one size fits all here. Continuous is not necessarily better than discrete, and discrete is not necessarily better than continuous. But dependent on the type of edge you're extracting from the market, yes, there is a difference, because we're saying in the tails, there is a specific reason why we adopt these discrete process, non-predictive processes, as opposed to risk management processes that are continuous in nature, and is assuming that there is more information that we can capture to mitigate risk when we are in our trade event. So, these debates, they get very complex. We've got to understand the nature of the models we're deploying, the nature of the edge that we're harvesting, because it's not a simple riddle to unpack.
Well, I don't think I would have started an ETF like this if I didn't think that and I'm not saying I'm right. I'm just saying I have to believe that certain strategies, even though they're more tailored for, or let's say less tailored for what clients think that they want and need, I think they'll eventually prove themselves out. And I don't know if my argument's ever going to win, but I do think that I'm relying more on the performance. And so I think our ultimate argument needs to be, there is a reason we don't do it. It's just not because we want to prove a point. It's because there is too much of a downside to getting away from one entry, one exit, and a stop loss. And if that doesn't prove itself, then we're not going to win any argument. And so I think what I've tried to do in my private fund and in my ETF, and then whenever I'm on this spaces or in a podcast, I'm saying the same thing, and that is, these things matter. I'm going to set up a situation where trend following has all of the advantages with the markets and the stocks, and apply this type of strategy, and it's going to work. And people are going to change their mind, not everyone, but it will objectively be superior. And I'm not going to rely upon my debating skills, and I'm not. It's going to be better, and everything is going to be better. It's going to be objectively proved. I get direct messages from people. Like yesterday, one of my close friends, who I've never met. Well, I have a lot of close friends I've never met, like most everyone on this spaces, right? So he sends me this direct message, and it's something like, I'm listening to Florian Corit, and I'm thinking, oh, classic trend follower. And then I'm like, no, not classic trend follower. And Jerry's making fun of them a little bit on his tweets, trying to be nice, and I'm giving them some props for their 500 markets and 2,000 stocks, right? And then I'm kind of making fun of them for saying that they don't over-optimize, but then quoting him, in my opinion, talking about over-optimizing. And he says, okay, I thought Florian Court was this classic trend follower, but they're not. So it's just back to four people again. Mulvaney, Richard, Moritz, Jerry, and I'll throw in Mike Melosinos. So it's actually five of us. So we're back to those five. And so how has there ever been a fair debate, Niels always says, well, in my experience, I don't see any difference between this. Well, what's your 99.9? Well, 100% of managed futures, vol manages and correlation manages and has continuous systems and always has a position on. It doesn't use stops. There's no way to even compare them to who? Me? Because I'm the most high-profile person of that five, and I'm not really that high profile. I'm hopefully going to be more high profile. So let the games begin. Throw the ball out there, and let's get going. But we're just getting going, and we need to win on performance, not on debates.
Oh, very interesting words. So I want to say that people, on one hand, they like fast results, they like consistency, month-to-month basis, and all this. Most of this leads to ruined accounts. This fast phones, and so on and so forth. And on the other hand, people like buy and hold, and we as trend followers have benefits from these both types of strategies. And if we are talking about buy and hold, we are more beneficial than we look more good, more attractive than even, I think, to people who not involved in investment processes, who don't know much about this, but I think we are more attractive. People simply don't know about our philosophy. It's my position, because I have said before that if you look, I have seen a lot of movies, books, even cartoons, where people there in these movies talking about stocks, and almost always they mean buy and hold strategy. And so I think it's wrong understanding of the people what is going on here. And our philosophy, if it would be wider, it would be attractive. I think it will be attractive. That's my point. Because I have met people who know nothing about trading, but they say such things that how can I have said to them that I'm a trader, and they don't know what is to be a trader, and they say how it can be profitable because markets and the future is unpredictable. And I say yes, it's unpredictable, but we have an algorithms, we have mathematical models, and we don't need to predict. We win because of our mathematical approach. People like it. And so with diversification, with risk management, and people say, you can lose all your money in one event. And I say, no, I have a lot of the markets. I have a special formula for risk management. It's not so. I can't lose all my money only because of one event, payrolls or something like that. So I see that people simply uneducated in this. They only know that it's very good to invest in stocks and to invest in real estate or something like this. And so I think real estate is more beneficial than stocks in some sense. So
when we go through this TTU mini series that Niels has produced, we recognise that a lot of these people that are calling themselves trend following managers, they've got different objectives in mind. Some of them are specifically responding to developing programs that respond to crisis alpha. Some of them are responding to the need to deliver absolute returns in 100% trend following plus nothing style. Even though we haven't heard of them yet in the mini series, hopefully, Jerry, you get on there and you can talk that talk. But so many different managers have different objectives, and their rationale or their approach that does respond to those particular objectives. Most of the CTAs I've heard on that mini series are not delivering a trend following plus nothing solution. What they're doing is they're recognizing, or they're assuming that they want to offer some property from their programs that can be utilized by traditional portfolios to, enhance or diversify their returns. So they're looking at models that can be included within traditional portfolios. And there are specific reasons why they therefore develop particular strategies, particular methods, continuous styles, etc., to provide those objective properties that can be meet those sort of the traditional portfolio or those investor demands. But there's the absolute return question. Which is a method? 100% trend following plus nothing. Can we deliver these absolute returns? I argue we can, but I also argue that the particular regimes we've experienced, particularly over the last 10 to 20 years, have certainly not been favourable for that ability to deliver those absolute returns, because we've had something very unusual going on in the last 10, 15 years, where central banks have significantly been impacting the volatility of the markets, etc., which has impacted our ability to deliver these absolute returns. And that's where these alternative CTAs that are offering these different objectives say, hey, we're using these more complex overlays, etc. We're finding that we can respond to these environments better. And the question is this something that's going to be continued in the future through these the more traditional classic trend following approach? And I'd say yes, because the past that we've seen over the 10 or 20 years is just a few narrow regimes, and there are times where we can demonstrate through our particular process that we can deliver absolute returns, but it requires these markets to get quite chaotic, which we know they can. And in these instances, there are times where we do feel that our approaches do provide greater absolute returns than what these other smoothing approaches do. So, it's about objectives, what's trying to be achieved, what you're trying to call yourself. Don't call yourself a trend follower if you are just providing a solution to sort of augment a traditional portfolio. There should be another term for that type of program. Let's be more defined in exactly what the program is trying to achieve.
yes, I have seen a lot of guys who call themselves trend followers, especially in the short-term space. But when I ask them what is your approach, and I have seen that their answers wasn't meet our criteria, and I have seen this a lot. And I want to add about diversification that people simply don't understand. A lot of people don't understand what diversification actually is, because today I have seen one trader in YouTube, and he said that he doesn't like diversification because, and he said that, for example, you can see the main stocks, SP 500 was moved down this year, 2022, moved down all the stocks of all the main stocks. Yes, main stocks, but it's not a diversification. Diversification is when you trade currencies, commodities, ETF maybe, okay, currencies, commodities, stocks and bonds, and you can also diversificate, as we all know. It's enter and exit diversification. So people think that if they trade Microsoft and Google, they are in a diversification process, but it's not so. So I have mentioned that people don't understand what diversification is, what risk management is, and it's very important. It's the main things, I think, in our philosophy to understand this.
Yeah, I just wanted to make a little comment on the analog versus discrete debate. In my view, the distinction between analog and discrete is not binary. It's not discrete. It's also analog. in a very funny. I mean, it's a funny statement to make. And why I say that is because, so I can probably just give one example just so that Jerry can understand it better. So he's discrete, and there's this other guy that says he's doing analog, and Jerry uses one entry, one exit, and one stop loss. But if Jerry, let's say, has I don't know, five entry parameters and 5 exit parameters and 5 stop loss parameters. So it's not one, but it's 5 each. And then there's permutations of those 5s. So he can have, I don't know, 5 times 5, 25 times. So there's 125 instances of his system that he can trade at the same time. When all those 125 systems are traded on a particular market, it's almost guaranteed that Jerry will always have a position if those parameters are chosen carefully to cover a wide range of like lookbacks and stop losses and exit parameters and whatever. They can be built so the 125 systems can cover an area instead of a point into this three-dimensional space. And this area, this three-dimensional area, having 125 points pretty much covers the whole area almost analogly, not discretely. And when these 125 systems are traded at the same time, there will be adjustments. There will be adjustments. So Jerry would be going from minus 100% short to plus 100% long, and anywhere in between. And depending on how these 125 systems are positioned in or out, he could be 13% long today, 17% long tomorrow, 27% long tomorrow, and then back to 17% long today. And so if he adjusts daily or weekly, it will appear to an outside person, if they don't know what Jerry is doing, Jerry's strategy, so-called discrete strategy, will almost be indistinguishable from an analog strategy, which is also adjusting things daily or weekly or according to the markets. Jerry is adapting to the markets, whatever the markets are telling him to do, and the analog guy is adapting to the markets and whatever the markets are telling him to do. And somebody watching these two traders trade this way will be unable to say which one is trading discretely and which one is trading analogly. So to me, I don't know. What do you think, Jerry?
Yes, exactly right. I mean, you did a great job. And I think, number one, it's all about, is it one system or is it a dozen? And it makes all the difference in the world. As long as it's one entry, one exit, in 12 systems or 10 systems, perfect. The sample size is not being compromised. And then the author knew about this. He knows this. There's nothing we can tell him that he doesn't know. Why do you leave that out? Even I can come up with the idea that, oh, true, but multiple discrete systems, one entry, one exit, and a stop loss, will look like this continuous type system. Why does he leave that out? I mean, why do that? It makes no sense, So it's very frustrating to deal with people who write things on podcasts who are super smart, smarter than me, and yet they make it so easy. It's ridiculous. I mean, I don't even know what to say. But you did a great job of explaining it. Keep going.
Yeah. So that's to me, the debate or the boundary between whether somebody is discrete or analog or continuous is not binary. it's very hard to distinguish between people who are doing things discretely or analogly because of this argument. Because any discrete trader which is sufficiently diversified, like Richard or Jerry or others, it becomes almost indistinguishable from an analog trader or a portfolio manager. So I think last week, I try to remember. Oh yeah, I had this. Was it a thought or it was a reply to a tweet or something, which I don't think I've mentioned before, about how because so like classical trend following that keeps the size fixed, and because of the inherent asymmetry in reality of markets, which is the upside is unlimited and the downside is limited to zero. And if you keep a size fixed on a long and a short with classical trend following, I made the point in an argument that because of this inherent characteristics of reality and markets, this makes classical trend following have a long bias, because all the outliers, the unlimited profit is only applicable to the longs, whereas to the shorts, the unlimited profit cannot be applicable because the profits will be ultimately limited when the market hits zero, or if the market hits zero. So on every short trade, the profit is known, the maximum profit is known, whereas on the long trade, the maximum profit is unknown, it's theoretically infinite. And this inherent asymmetry makes classical trend following have a long bias. And if we agree that this is true, which I think it is, then there may be this inherent long bias of classical trend following may have benefited from the 50 years of fiat money printing and inherent inflation and increase of money supply, which is giving an upward bias to almost all the assets that trend followers are trading. So classical trend followers, even though they didn't do this deliberately or knowingly, oh, okay, so all markets have long bias, and let's build a strategy that will also have a long bias and we'll be exposed to it so that we make more money. But I don't think anybody did this deliberately. But nevertheless, the fact remains that classical trend following, where position is not adjusted, does have a long bias. And prices over the last 50 years have had long bias of assets because of inflation and because of increased money supply when the world disconnected from the gold standard. And to continue this argument is that in a world in which these 50 years stop being the 50 years, where the world becomes more like it was 200 years ago, 250 years ago, or whatever, where such blatant increase of money supply was not common and was not proper, was not normal, whether classical trend following would suffer because of its inherent long bias. And in a world in which such long upward bias in global prices of asset does not exist, whether adjusting to volatility and adjusting to your size, which is inherently symmetrical, it gives symmetrical view of longs and shorts, because theoretically you can make infinite profits as a market goes down from 10 to 0, slowly as it goes to 10, 9, 8, 10, 1, 0.1, 0.01, and you adjust to that. And as long as it just keeps going down and you adjust to it, that trade will be indistinguishable from a trade that goes from 10 to 100. So a trade that goes from 10 to 1 will be indistinguishable from a trade that goes from 10 to 100 if you adjust for volatility. So when the profits from longs and profits from shorts become symmetrical, my hypothesis and what I'm proposing now for discussion is whether in a world which is more symmetrical about downward versus upward moves of assets, whether adjusting to volatility will be will be adapted to it better than classical trend following, which just does not adjust to the position. What do you guys think?
First, I'm not sure this phenomena of rising prices can be attributed solely to the fiat money expansion. We have examples of countries where we have a lot of money emission and not so much of asset appreciation. And an example that comes to mind is Japan. Another example that comes to mind is my dear Brazil, where the stock market is anywhere near flat when you look on a long-term basis. Okay, so I'm not sure we can take that as true, your first point. So, but even if I indulge in this assumption, and let's say that's true, let's talk about the benefit of trend following being long biased, and it has benefited from this asset appreciation. And when you're in a deflationary world where asset prices don't go up all the time, if you're tilted to the long bias, you're toast. Well, another example that comes to mind is the future contract of the VIX. The thing is, despite it has a limitation to the zero, the VIX index itself, and the VIX future, if you're trading one contract, then you roll to the next one, then you roll to the next one, you will see a downward drift that makes a short profitable, perhaps with no limit to the downside, because the term structure is such that you can benefit from this shorts if you're rolling one contract to the next one. I believe that this cannot be true in the stock market, because the stocks themselves, the price itself, has this limitation towards the zero. But on the futures market, where you're trading the term structure, you don't have this one, and this is another reason why perhaps it's best for us to trade futures instead of other asset types, because of the term structure itself. Okay, try to make this as fast as I could. Glad. Thank you.
That's good. That's good stuff. And we'll pick it up next week. I do think we've already seen periods like that. Probably the last decade is, probably a good example of where the longs kind of go away. And it's a good way of putting it, in that what happens, what are we going to do if the markets get dominated by shorts? Because we have seen periods where shorts help out, and they have been sort of periods where profits have come from shorts. Crude, especially, a couple of times for me, had big downtrends. What was the last year where crude had a material? Was it 1986, going back, and then 14, I think. So we have seen periods but overall, they're not going to pan out. So what are we going to do in these periods where the shorts are the only trends we have, but they're not going to be the mega outliers we need and that we got in the back test? So that's a very good issue to deal with in the future. And thanks everybody for the best wishes on the ETF. And hopefully it shows up soon on your ticker. I'm not sure how it all works. I'm going to be the first buyer on Thursday, and I'm going to step in there and buy a chunk. So hopefully when I get in Thursday morning, I see it on my screen. That's my big concern. Where is that ticker? Yeah, I'm going through IB, and I love IB, but they have some issues sometimes. So hopefully it all works out and we're ready to go. I know I'm ready, and I think everyone is ready, or going to be ready by Thursday. So anyways, I appreciate all the best wishes. So I will let you go and wish you a happy weekend, and see you next week.